everyone, it's Howard from Haiti Break. Today I want to talk about one really simple topic. It's we are looking at multifamily in 2021, and I actually, in fact, just come back from the market, from the Midwest market, and we didn't look at a lot of opportunities. We just focusing on a couple of opportunities that we think we have a strong opportunity going in. But today I'm not talking about that. Today I want to share. I actually read a very interesting article. While I was coming back, you see that I'm in the very nice hotel room quarantining for my 3 days. I'm being a really responsible citizen and quarantining for the 3 days. And this is my day number one. You see that I'm really good spirit and see how that goes as the time progress. But today I want to talk about one article that I read, and I find it very relative to relatable as in what we're going into the apartment investment in 2021. And it's actually from a CBRE article that I actually have it right here at the screen, and it's basically, I said, it's 8 factors on affecting making our decision in multifamily in 2021, and it's ranged from economic rebound, low vacancy rate in Class C properties, and workforce housing, largely spared by the COVID, as we know, as 2020 moving on to 2021, and number 4 is amenities becomes non-matters during COVID, because you don't have amenities in terms of all these big urban market able to give you, and then suburban living space becomes much more relevant, and high rents in urban market has becomes a push factors for investor like us, and for my investor who partner with me to go into the Midwest market and lifestyle. And then number 8 is it becomes an urban shift to suburban shift, from basically all these high paying jobs, tenants that is living in the urban area as shifting to suburban shipping. So and then eventually we can talk about investment strategies that is basically making sense for investor like us, for an investor like you who wants to really partner in investing in the United States for 2021. And let's go over each one of them in more detail, so that we give you a little bit of meat and what we're talking about. Number 1, economic rebound. So we all know, I give you an example before I read that background. I was in the airport. I was traveling for the last 3 months, 3 times, and I was literally in the Calgary airport, and I was in the Denver airport, and also in the Cincinnati airport. I noticed just raw traffic increase. I was early in the year. I was literally maybe 10-15% of the people were feeling it. Literally now in the 60-70%. And when we're walking in the airport, you see people are really obeying the law, putting the mask on. That's important. But more importantly is how many people is actually in the airport. I all the time that when I talk to Canadians, Americans, when I go to shops, when I go to buy fast food, and what they always tell me is I'm just so happy to be coming back to work. I'm so happy to be opening. So number 1 is economic rebound. Economic rebounds lead to multifamily demand, and we all know this, largely because of the economy unreleasing, reopening, and certain among renters is moving out of the tenants of the homes of their parents' home, which they were forced to do that during the economical situation. The COVID hits, and a lot of them lost jobs. So all these young adults moved back to the parents' homes, and now as they find jobs, the economy rebound. Last I read, U.S. economy rebound is going to be in the 6% GDP. When is the last time you see 6% GDP increase for United States? So I don't think anyone would know the effect of that yet until actually seeing that But as I've been proposing at the beginning of the pandemic, March, I said that you have to build on broker relationship, you have to build on the deal flow, you have to build on all these things, and I explained many different times. You have to do those things when the economy is worse, when the economy is not doing as well. You have to get engaging with investors, get engaging with, you have to build the relationships. So I don't know whether you did, and as I was telling all my investors, my follower on my channel, I tell you guys you have to do it. I was doing it as well, and I was doing broker relations where I was expanding different market. I was talking to brokers and get the flow going, and I didn't have a crystal ball. I just knowing that what comes down must goes up, and I didn't predicting exactly when it would happen, but we know right now the economy is reopening slowly but surely. And Biden, I think 2 days ago, talked about May 1st. Every adult American is going to have access to the vaccine. So what that does is really simple. We are already past the lowest point in terms of the jobs, in terms of the employment rate, unemployment rate. And what is really important is rent is going to go up. As our business, as many business, rent is going to go up, and what that means is going to drive those rent up. So economic rebounds, number one, is very important. So make that note. That's basically is like it's C is rising generally. The C's, the level go higher, the boats go higher, right? And it affect every single one. Affect definitely apartment buildings. Okay. So number two is we talk about what we're doing is investment in the C properties, right? In the C properties in suburban areas. But let's talk about C properties versus B and A properties. So we also talk about at the beginning of the pandemic how Class C property have more to offer, more value to offer comparing to A property. It's really simple. When the jobs market got hit, when the pandemic got hit, when the situation got really bad, a lot of tenants have no choice but they have to move it back to Class C properties, and that make it the Class C property. I experienced it myself. I have 100% occupancy at my properties, and what that really means is going to stay really strong from 2020. No one expect that. No one expect that workforce housing is really largely spared by COVID economically. I'm talking about here. No one expect that, but this is what happened. Vacancy for affordable multifamily will remain very low in 2021, which it has for 2020. And like in previous recession, more and more, unlike in 2008 and other recessions previously, more affordable housing inventory maintained very low vacancy. Among the rent growth in 2021 is actually one of the highest. So Class C properties had higher delinquencies previously, didn't happen this time. So that's what driving our decision making, by the way. When we talk about economic growth for all classes on all tenants, this is particularly benefiting us Hit going into the market that we know in the type of properties that we know that have value for Class C tenants. So that's why we are so excited to going in 2021, keep doing what we're doing and working with and partnering with investors just like you guys, and knowing us have the relationship building with you. And that's what really exciting. And in fact, I just come back and I'm staying in the hotel, and I'm so pumped because I know I have so much to report to all of you who'll be watching this video, watching this channel, knowing that I didn't just start out to do this like last month or last week. I wouldn't say I predicted, but I would say that this is something that I continuously work on, and I know the market will recover, and I know the market actually. Later on, we talk about the market. That's something that we're really exciting. Want to share with you because it's confirming what we were expecting years ago. What we were looking at the market years ago, we think that had potential and is largely fulfilled, and it continues to do well. And this is just the beginning. So again, Class A asset impacted by mostly in COVID by this year, 2020, due to higher turnover, young actors moving back to home. Class C tenants usually, if they are by themselves and they have a big family, they can't move the whole family back home, so they stay there. And also the Class A is also much more higher rents, so a lot of Class A tenants move to Class B tenant, and Class B tenants move to Class C properties. Class C properties. So A to B, B to C. That kind of like triggering effect has become making C properties much more affordable and much more resilient. And because tenants just need a place to live, you can cut the level of expense of your apartment, but you can never cut it completely. And when you cut, you're going to move in a more economical properties. And in fact, it's co-related, and it's really related to what we're doing in our market. We find C properties to renovate it to our property that is not an expensive B, but give a lot of values for B or for C class tenant, that they can find between like kind of level between B, C, and B, that giving them a high level of quality, high level of renovation. At the same time, we're achieving rent increase, not as much as B, but finding a sweet spot, the niche market that I was talking about, that really becomes such a thing that we do well and continues to do well, and we will continuously to doing it when we're doing a value add, when we're looking at projects. So finding C properties to bringing up the values, to increasing the amenities and in the units, to giving a choice for the options for tenants to move in and to increase the rent for us, work better for our investors. It's just such a win-win for investors, for tenants, for our company, and whoever that is partnering with us. So workforce housing is what we're continuously doing it. And there's no other way to do it, because workforce housing is spared largely by economic, by the COVID, and it will outperform. It will be outperformed in 2021, much better in Class A, and it is something that we didn't set that when I say that, I also don't want you to think that I have a crystal ball. I don't have a crystal ball. In investing, you do your research. You do your market research, you do your due diligence on your properties, and you are working with local professional property managers, brokers, and you find those opportunities, and you're working with local contractors to bring up the value. But we never have a crystal ball. We do the due diligence as we walk around the neighborhood, drive around the neighborhood, talking to tenants, and we open up pockets within the neighborhood that we believe they have values, and then we pull the trigger, and then we work with investors to do that. And again, so that is why we're so excited in Class C. And moving on, I want to talk about in COVID, it's very special and unique in terms of segregating between different classes of property. And one of the things is about amenities in the urban, suburban area. When you talk about major cities, you talk about San Francisco and New York, Boston, all those major cities, they have a major urban amenities. They have all these big shops, all this, they have all this big shop and all this important amenities, entertainments, restaurant, nicest culture, amenities, sports, etc. And it becomes not matter. It becomes almost not matter, because in COVID, everyone was largely have to stay inside, and all the event has been basically canceled. That's also make it, when you're living in a Class A, when you're living in major population centers, there's not much things that you can do comparing to, if you're in New York, you used to be able to see, boardwalk shows, and you're able to see all this, go to the nicest restaurant in the world. It becomes not matter in COVID, and that has make a huge impact for tenants to basically looking at comparing different classes, comparing different urban, suburbans. during COVID. Why I'm paying higher rent? Like this is basically coming down to why I'm paying higher rent for those kind of properties, those kind of amenities that is I cannot enjoy in COVID years, and that has make a major impact for the attractiveness and how tenants base the decision on picking different kind of properties, or different kind of market to live in. So so that's also benefit us, right? And this is not from someone, we are really active in Midwest market. It's not that we pick to tell you this kind of thing. This is actually from CBRE, from the largest broker in the world, certainly in the United States, and talk about how all this affect us as investors, as tenants, as people we are living into society. Suburban living space becomes very important also in 2020 and 2021 forever, going on to the future. Can be found in suburban, easier to live in suburban living, you have bigger space and you have cheaper rents. So, right? And then more living space, more living space desire as renters spend more time at home. This has coming up over and over and over again. If you are living in suburbs, you have much bigger space and you're probably paying less rent. And that's is something that we really pay attention on in COVID years. And that's really something that we believe is going to be it's going to be worth a little bit in the future. It's going to take its time, and people and renters will have bigger choice to live in a bigger space, and less rent is harder for them to completely reverse. And certainly some of the tenant will be, but trend has said, and how we live, we want space, we want park, we want balcony, something that we pay attention on when we look at properties too. Big space, suburban market, much more bargainable rents comparing to major CDB has make a huge impact. When we talk about in the beginning of the pandemic, and certainly going through carrying its weight going into deep in the pandemic and at the end of this, and also recovery. Higher rents in urban market. We talk about this cost benefit calculations. When the less benefits you have less amenities you can enjoy. Things like we were opening, don't get me wrong, but it's certainly in 2020 and then going into 2021, justification of higher cost of living become a question. And then it's just simple as this. I'm comparing with the Midwest market, Cincinnati, Dayton, and Columbus and Kansas City. So all these major Midwest market, and comparing to the plate on Almanac, Boston, New York, San Francisco and Seattle. All this basically the comparison between the two. Higher rent and less access to the amenities, which will certainly be paying the factor for 2021 and probably well into the future, because now you live in a bigger space, it's just hard to reward, right? And lifestyle, lifestyle is something that's really funny. Millennials moving into the life stage where urban living is more trade-off for less dense housing. A lot of millennial has been driven our country in U.S. and Canada in the world, and is already surpassed the past generation X, and already surpassed the previous generation in terms of the spending habit, and definitely on the housing selection habit. They are moving in the suburban market more for space, more for bang for the bucks, and they like to do a lot of things themselves, and they like to do quite differently from the previous generation, and this is certainly play a much bigger factors when we're looking at how millennials selecting bigger space, bigger bank, better values. Bigger values is much more important for millennials comparing to previous generations. And they can look at urban, suburban, they're gonna Class C, Class B, Class A, and they're gonna pick the best bag for their bucks. That definitely it will pay a major impact when we're looking at Midwest market comparing to major MSA market that has all these things, and that's why you're looking at, that's why Austin, that's why Atlanta, all this urban, suburban Phoenix area market that has been going up. But you know what? You don't want to go to there right now, because everyone's going there. If everyone's going there, you want to look for the next one, right? And that's what we're trying to do, and that's what we have been telling you guys what we are doing. We have been doing. Don't compete with the money. Go for the next one so that you settle down there. You buy there years ahead, so that when they come, you just go up with them. But you're already going. You're not competing with them already. So it makes sense. And suburban shift is really something that we is induced by COVID. Recession impacted by impacting the urban submarket, much like the suburban ones in 2020. As a result, suburban markets will lead the multifamily recovery in 2021. This is again not for me. It's not for me because I'm biased. It's actually from CBRE reports, and they look at all these different major markets and talk about the X factors that we talked about. How the millennials is looking at it, how there's 8 major submarket and the urban submarket in different market. And I'm gonna leave next video as a really important one because it's going to talk about the conclusions and the result and action 2021, how it affected multifamily investment 2021. And some of the major market we have been focusing on. We're really glad that we have boots on the ground. We do the work years ago, and now it's the time to go in. So if you are interested in learning more about how can you do it yourself, and how do you want to invest as a partner, or you want to learn about be hands-on. I have students that continuously learning and learn from the step that I've designed for my students, for my investors. Is very down to earth. That's something that I didn't reinvent. I learned from the titans. Has been doing this for years in US and Canada. I'm so excited to share with you, and it's my next step. But if you are not looking at someone like how this is a lot of work, I don't want to stay at home, I don't want to stay in a hotel for 3 days, and after you do a test, by the way, the COVID requirements and the quarantine, the test, and basically literally double my traveling costs. I used to pay $1,500 for every trip that I go to the US market. Literally, when I do the calculation, it's basically more than double my cost because I have to do the test, I have to do quarantine, which is $1,000, and the food, everything. So basically, it doubled my trip. So last time I was checking yesterday is over $3,300 of cost of quarantine, the test, and so if you're not looking for someone like this, you don't want to do this. So I'm so excited because I love to see my market. I love to meet my people. I love to see my property, how it's doing, and then telling you this on the video, and so that you guys have easy access. So this is something that I do love doing it. I'm really hands-on person. So I would love to talk to you guys who are looking for investment partners and get their investment returns. And I'm not going to talk about investment return on this one, but the call for action today is reply to this video and saying that just shoot a video, shoot an email to me, download my quick start book, basically telling you how to do it yourself. But if you don't want to do that, partner with me, send an email to me saying that I'll learn about market. Set up a time that we can chat and we can talk about investment. And I do have one deal coming up, yeah, if you want to talk about that, we can talk about that. We are basically at 100%, but we also working on another deal, and that's why I may be going back to the Cincinnati, Ohio market. But stay tuned for more. But I want to leave the conclusion on the next part of the video because it's such a key important part to talk about. What is that means for 2021? If the economy is doing so well for is doing not so well for last year, and now it's doing well for 2021. It didn't kill multifamily, so to speak. What we'll do when everything is go back to normal and you invest in multifamily? I think it's no brainer. I think in fact this is the perfect time to go in and make your mark and be partner or is investing in actively or passively in real estate, in particularly multifamily. Last year, real estate appreciated almost 10% when the pandemic hit. And when now we're opening, now the worst is already passed. The deal is already drying up in terms of investment are the good investment are definitely getting a lot of traction. So what that means is appreciation is coming in. So get in now while you can, because you know what? I can't stress it enough. This is a time to make your mark. This is a time to go explore and invest in the U.S. If you're Canadian, if you're U.S. investors, I know that you're already doing it. So good for you. Good on you. So again, send me email Howard at haytobreak HOWARD at haytobreak HAY numeric 2 BRICK.com, howardhaytobreak.com, or just send me call me directly. But I love to talk to you. It's my pleasure to be able to share these findings with you when I'm going to the trip. I have another video that I have on site that is talking about investment specifically. But this one, I will leave it just like that. Talk about 2020 and what it means to 2021. Stay tuned for next video. And Hey to Break, I'm glad to be having you. And I wish you well. And see you next time. Ciao.